The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
Hello, everyone. My name is Derek Doyle. I'm an associate advisor here at the Rhinebeck branch for John Ullman and Associates. With tax season 2025 in full swing, I wrote a blog that covered some of the new tax changes for 2026. With the new year underway, I want to walk you through some of the important tax changes that could save you money in 2026. The One Big Beautiful Bill Act was signed into law on July 4th, 2025, and this is going to be the first full year of some of these provisions, so let's break it down. First, we'll start with standard and itemized deductions. Because there's some big updates here, I want to cover this first. The standard deduction increased for married filing jointly to $32,200, and for single filers, it increased to $16,100. A major change here was the SALT deduction cap raised, which is now going to be 40,000. For previously, it was a $10,000 limit. So this is going to be a big deal if you live in a high tax state like New York, New Jersey, or California. Phase outs do apply for taxpayers earning over $505,000 though. There is also a new senior deduction available from 2025 to 2028. It is available to individuals age 65 and older, up from 6,000 per person. So qualifying couples can claim $12,000 total. There are income phase outs, but partial deductions are still available. Most people will still take the standard deduction though. If you are a high earner in a high tax state, you might want to look at the numbers and see if it does make sense for you to possibly itemize though. Here's a quick tax tip before filing. If you're close to the itemizing threshold, consider bunching deductions like charitable contributions or medical bills so you can clear the standard deduction number and itemize. Also, if your spouse and you are old or 65 or older, make sure you're accounting for the new senior deduction even if you don't qualify for the full amount. So now let's dive into no tax on tips and overtime. This is going to be effective for tax years 2025 through 2028. Qualified tips and overtime pay can be deducted from your wages. So for tips, the maximum deduction is going to be 25,000 per tax return, not per person. I almost caught myself there because that's how you would normally think it should be. It is going to be $25,000 per tax return, not per person. So joint filers share that $25,000 limit. For overtime, single filers up to 12,500 and joint filers up to 25,000. Only the extra portion of overtime income qualifies. So if you earn time and a half, only that extra time and a half is deductible. W-2 changes are coming for 2026 though. There will be a new box 12, which codes TP for tips or TT for overtime. No W-2 changes for 2025. Those are going to all take effect in tax year 2026. Income phase outs will begin at 150,000 for single filers and 300,000 for joint filers. So here's a quick tax tip if tax on overtime or tips might qualify for you. If you earn tips or overtime, this deduction is definitely worth tracking throughout the year, keeping a record of your qualified tips and overtime wages and not waiting to piece it all together come tax time. And if you're a joint filer where both spouses receive tips, remember you're sharing that $25,000 cap. So your combined total number, knowing it early, will help you plan later on in the year. Let's move on to retirement plan contributions. If you're contributing to a 401k or 403b, especially if you're a high earner, this is obviously an area where you might want to pay attention. Standard contribution limits under the age of 50 are now 24,500. Your catch-up contributions, ages 50 to 59, are an additional $8,000 on top of that 24,500 base. And for ages 60 to 63, there's an additional 11,250 on top of that base contribution. We consider this a super catch-up. Key changes for high earners. So if you're a FICA wage exceeds 150,000, catch-up contributions above that base 24,500 contribution must be Roth or after tax. You still can deduct the 24,500 pre-tax, but anything above that must be taxed before going in. So here's a planning tip. Roth dollars do grow tax-free and have no RMDs, which is nice. So it is great for long-term planning, but if you're in, let's say, the 35 or 37% bracket, paying taxes now may not be worth it. In that case, consider sticking to the pre-tax limit now and doing Roth conversions maybe later on when your income drops. I think a key question you want to ask yourself here is, what do I expect my tax rate to be in retirement today compared to what do I think it'll be later on once I stop working? It might make sense to defer taxes now with pre-tax contributions and then do a Roth conversion later once you're at that lower rate. So finally, let's move on to the last section, Trump accounts. This is a brand new savings vehicle called the Trump account, designed for children. One account per child managed by an adult until the age of the child turns 18. It is eligible for any U.S. child under 18 with a valid Social Security number. Government contributions, this is a key one. Children born January 1st of 2025 through December 31st of 2028 will receive that seed $1,000 government contribution. Children born before 2025 can still have an account, they just don't receive that government seed money. Here are some contribution rules for the account. The accounts cannot be funded before July 4th of 2026. The annual limit is going to be $5,000 per year. Parents, family members, all their contributions are after tax and are not deductible. This can be used alongside a 529 plan as a complementary savings tool, but not to holistically replace it. Rules are still being finalized, so stay tuned for IRS guidance as the year progresses. As I mentioned before, even though contributions to the Trump account aren't tax deductible for parents, the real value here lies in the tax advantage growth over time. You have 18 years of that tax advantage growth and can really jumpstart a kid's retirement, especially with that $1,000 government seed money. And think of it as a piece of a broader picture when pairing a Trump account with a 529 plan. It gives your family more flexibility since they are two accounts and they do serve different purposes as your child grows. And there you have it. Those are some four major tax changes to be aware of heading into 2026. Whether it's deductions, retirement planning, or saving for your kids, there are some real opportunities here for you to plan ahead in 2026. And as always, working with a qualified financial planner can help you make sure that you have a strategy that's built for your specific situation.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.